Hi, my name's Eric, and I'll be reading you selections from Barrons magazine with an issue date of August 4th of 2025. This is produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We'll start with Up and Down Wall Street. LL Bean does a reboot. Who knew change was its bag? By Andy Serwer. With the flurry of economic reports and tariff news this past week coming faster than a Shohei Ohtani fastball, Barron's readers might be forgiven for being seduced by myriad zigs and zags, and yet, as Mr. Market often reminds us, it's best to ignore much of that and focus on the bigger picture. In fact, happy manifestations of long-termism abound across America. In Mid-Coast Maine, where I'm currently bunked down, there are numerous examples, including at the Farnsworth Art Museum in Rockland. William Alden Farnsworth was a local 18th century mogul with interests in kilns, quarries, real estate, and shipping. His daughter, Lucy Copeland Farnsworth, who died in 1935, multiplied the family fortune fivefold over her 96 years through investments in equities and real estate. Inside the museum are ties to more recent fortunes, such as Jamie Wyeth's Iris at Sea Study Number 2, bequeathed by Elizabeth Noyce, ex-wife of Robert Noyce, who co-founded Intel 57 years ago. Elizabeth owned hundreds of millions of dollars of Intel stock, died in 1996, and was called Maine's premier philanthropist and most innovative investor. Her daughter, Penny Noyce, continues that work through the Libra Foundation, which most recently had some $170 million in assets. The Farnsworth has an impressive collection of Wyeths, that first family of American painters, which includes N.C., Andrew, and Jamie, best known for Andrew's Christina's World. As you may know, the subject, Christina, is lying in a field in front of her home, the Olson House in Cushing, Maine. But did you know that house was later owned and subsequently given to the Farnsworth by John Sculley, former CEO of Apple? Another Wyeth enthusiast was Linda Bean, granddaughter of Leon Wood Bean, founder of Maine retailer LL Bean. Linda, who died last year and dabbled in conservative politics, collected some 24 Wyeth paintings, later auctioned off for $2.5 million. Her company, Linda Bean's Perfect Maine, operates a lobster processing business, restaurants, stores, and the N.C. Wyeth Research Foundation and reading libraries. Linda was also on the board of LL Bean, which is 100% controlled by the family. As it turns out, there are other big changes afoot at LL Bean, with a $50 million reboot of its iconic campus in Freeport and CEO Stephen Smith stepping down. Smith, who previously worked at Walmart and was the first outsider to run Beans, as it's sometimes called, in its 113-year history, will have been CEO for a decade when he decamps next spring. 10 years is also a natural inflection point, a clean milestone that allows for reflection and renewal, Smith wrote to me in an email. The company is in a strong place. We have a clear vision and momentum across the business. This is kind of a victory tour for Steve, says Maine native Dave Rue, managing partner of investment firm Bay Pine. He came in at an incredibly challenging time for the business where things had gotten a little fuzzy. Steve focused the strategy, upgraded the team, refurbished the brand, improved sourcing, and started really using data analytics. And yet, Smith's departure raises some timeless questions for LL, which operates 65 stores in the U.S., LL Bean, plus 25 in Japan and 14 in Canada. Can LL Bean keep up with competitors like REI, Patagonia, North Face, and Stio? Can Beans make its apparel more appealing or even cool? Will the company seek outside capital or go public? Then there's top-line growth. In 2024, revenue came in at $1.7 billion. It's down from a peak of $1.8 billion in 2021. The company doesn't release profit figures, but its employee bonus performance payout dropped from 20% in 2021, 12% cash, 8% 401k contribution, to 6.5% last year. Before you call in the management consultants, recall that LL Bean has shifted gears previously in its 100-plus year history, morphing from a single store to a direct-to-consumer powerhouse via its ubiquitous catalog. In 2007, the company sent out 375 million of them. True, it was late to back-office technology, bricks and mortar expansion, and the internet, but they figured it out. Still, much is riding on the next, yet-to-be-selected CEO, as well as Sean Gorman, the executive chairman and great-grandson of founder Leon Wood, who ran the company from 1912 until his death in 1967 at age 94. The story has it that his middle name may have originally been Linwood and accidentally changed to Leon Wood. A true Mainer, LL, was crusty with an extra dry sense of humor. An example of the latter directed to those out in the woods: if you get lost, come straight back to camp. Leon Gorman, LL's grandson and Sean's uncle, ran the company from 1967 to 2001. Leon Gorman really built the business, says U.S. Senator Angus King, an independent in Maine. When he came in, the company had sales of like $3 million. And when he left, it was $1 billion. Leon was kind of a genius. I remember a story where he said at a company meeting, "I think we should put Hawaiian shirts in the catalog." And everybody said, "You're crazy. People don't want Hawaiian shirts." And they sold like hotcakes. Clearly, LL Bean profited from its association with Maine, King says. It has this brand of outdoors, quality, integrity. And fortunately, that's Maine's brand. The development of LL Bean and the growth of Maine sort of go hand in hand. Only a few states, California and Texas among them, have an identity as strong as Maine's: lobster, wild blueberries, and rugged coast. And the state certainly punches above its weight, considering its population, which is number 43, and gross domestic product, which is number 44 rankings. Thousands of Maine businesses monetize the state's attributes, but none more so than LL Bean. And yet, Bean's $1.7 billion in revenue doesn't crack the National Retail Federation's top 100 U.S. retailers list. Number 100, with $4 billion in sales, is St. Louis-based Schnucks. Like its home state, LL Bean's mind share exceeds the data, which is both a problem and an opportunity. At Bean's flagship store in Freeport, where in its shadow the cutesiest outlet town in America has blossomed, the massive renovation makes for some discombobulation. The apparel shop has been moved into a 28,000 square foot tent. Inside, I found much of the attire not so appealing, but one, an editor once told me I lacked the sartorial gene, and two, I'm probably pining for my 1980s official preppy handbook glory years staples: green felt hat, cream-colored chamois shirt, and navy Norwegian sweater. Other departments on the 220,000 square foot campus, visited by 3 million customers each year, resonated more. There's the hunting and fishing building, open 24 hours a day. No locks on the door, an employee says, originally to accommodate hunters coming from New York or Boston who would stop for supplies on the way to camp. Inside are thousands of wet and dry flies, midges, nymphs, and terrestrials, and scores of long guns. Excellent moose options leaned up in racks, some adjacent to brimming jugs of maple syrup. Bean's home store, organized by zones like Blueberry, which includes blueberry foods, themed dishware and cushions, and even the Robert McCloskey classic Blueberries for Sal. It was well curated enough to impress even Ralph Lauren. If I had a house in Maine, I would furnish it from L.L. Bean, a wealthy woman from Washington, D.C. tells me. To be clear, though, L.L. Bean is that rare bird that appeals to red staters and blue staters alike. L.L. Bean's powerhouse product is its boat and tote canvas bag, first sold in 1944 to carry ice, and which, like the Maine hunting boot, is still made in the state. An influencer blew the bags up when she began posting the boat and totes of customers who had monogrammed spicy messages, psycho, tax evader, Piper, no, on their bags. Vintage boat and tote bags now go for hundreds of dollars, as opposed to roughly $50 for a new medium-sized bag with a monogram. The company made 720,000 bags last year, which Smith says have brought in more new buyers than any other category for the past 4 years. LL Bean recently sued a company that was touting a boat tote line of bags. The lawsuit includes pictures of Hailey Bieber, Chloe Sevigny, and Reese Witherspoon with their boat and totes. It subsequently dropped the suit, and boat totes are no longer for sale on the defendant's website. LL Bean has some 5,400 employees, with 2,600 in Maine, as well as 3,700 seasonal workers, needed when you sell 8 pairs of wicked good slippers a minute in peak season. Working the store can generate serious yarns. It was January 1978, and I recognized a customer in the men's clothing section, says Stu Roberts, hired by Beans out of college. I was pretty sure I'd seen him on Saturday Night Live. Yes, it was the future U.S. Senator Al Franken with his mother and girlfriend trying to outfit him. I joined in helping him find a good owl, the appropriate tweed hat to go with his new LL Bean outfit. There were a lot of great jokes made about his new look. Roberts never got his dream job at Beans. I interviewed for an opening in product development, the sexiest department, he recalls. The interview included a visit to a psychologist's office, who gave me 2 hours of personality analysis tests. Roberts' report came back saying LL Bean shouldn't hire him because he wasn't team-oriented. The psychologist said, Stewart wants to go where angels fear to tread. In September of 1978, I relocated to Colorado and began my career as an investment manager. I would go to many places angels feared to tread. To those who say LL Bean should take a few more risks and venture to where angels fear, remember, that's where fools rush in. Or it could fatten the bottom line by short-shrifting customers and employees, though that would draw LL and Leon back from the dead, shotguns primed. Instead, LL Bean reminds us that while longevity doesn't come easy or cheap, practiced right, it can be rewarding in oh so many ways. We'll move on to the economy section of Barrons for August 4th. The headline reads, Stagflation is coming. Don't blame the Fed, by Randall W. Forsyth. Kill the messenger. After a weak July employment report, President Donald Trump Friday added the head of the Bureau of Labor Statistics to the ranks of the unemployed. But the softer jobs numbers aren't a portent of recession. Instead, they signal the onset of stagflation, the result not of the Federal Reserve's interest rates, but the Trump administration's tariff policies. The uncertainty after Liberation Day in April has been followed by a sharp slowdown in hiring. Data released on Friday morning showed that non-farm payrolls rose 73,000 in July, about 30,000 jobs shy of the consensus guess from economists. The real shock was a massive 258,000 downward revision in the prior 2 months' totals. Prior to the jobs report, Trump had let loose a barrage of criticism of Federal Reserve Chair Jerome Powell for not cutting interest rates. Unable to fire the head of the central bank, the president instead directed that the BLS commissioner, Erica McIntarfer, be sacked. In an online post, Trump claimed that the Biden appointee faked the jobs numbers ahead of last year's election, but was responsible for large revisions in initial estimates. Revisions in the key payrolls data, to some degree, may be traced to the declining response rate among businesses to the BLS's monthly surveys, according to economists who watched the data. The BLS also points out that the confidence interval for the payroll number is plus or minus 136,000. That means the latest report could have shown a 209,000 increase or a 63,000 decrease with a 90% probability. That's out of a labor force of 170 million. That said, the main number to watch now is the unemployment rate, derived from a separate survey of households, said Powell at his Wednesday afternoon news conference after the central bank's two-day policy meeting, at which there was no rate change as expected. The jobless rate ticked up by 0.1 of a percentage point to 4.2% as expected, which reversed the previous month's drop. The unemployment rate shows that the job market is in balance as both the demand and supply of jobs have been declining in tandem, Powell said. But a jobless rate in the low 4% range indicated the Fed's was closer to its maximum employment mandate, while inflation remains above its 2% target. The core personal consumption expenditure gauge, which excludes food and energy prices for volatility, was up 2.8% in the 12 months through June, higher than Powell estimated at the news conference. Over the past 6 months, core PCE inflation has run at a 3.2% annual rate. That's up from 2.2% last fall, noted Michael Darda, chief economist and market strategist at Roth Capital Partners. But the miss on the jobs numbers put a September Fed rate cut back in play. A quarter-point cut from the Fed's current federal funds target range of 4.25% to 4.5% was given an 81% probability by the futures market on Friday, according to the CME FedWatch site. That was more than double the 37.7% probability just a day earlier, reflecting the relatively hawkish tone taken by Powell at his presser. The latest month's data superficially resembles the year-ago pattern, which saw weaker than expected July jobs leading to a bigger than expected half-point Fed rate cut. What's different this time, at least according to Komal Shri Kumar, president of Shri Kumar Global Strategies, is Liberation Day. U.S. companies have been in doubt about how much of the tariffs were going to stick, he said in an interview. That uncertainty initially has led to a low level of hiring, but not much firing. So far, sackings haven't been evident at the unemployment offices. Initial claims for jobless benefits have averaged 221,000 per week over the past 4 weeks. That's a historically low level. Ahead is the second stage, with poor hiring, rising layoffs, and a rising jobless rate as companies deal with price pressures, Shri Kumar continued. Average hourly earnings have accelerated sharply to a 3.9% year-over-year rate of increase, he noted. The Employment Cost Index, Powell's favored labor cost gauge, was up 3.6% in the second quarter from a year earlier. To counter the squeeze on profit margins, he sees more companies, such as Procter & Gamble, pushing up prices. P&G said in its earnings call this past week that it looked to hike prices on about 25% of its ubiquitous household products. The cost pressures are evident in a $30 billion drop in corporate tax revenue, writes Joseph Carson, former chief economist of AllianceBernstein, in an email. While the federal government may be garnering extra revenue from tariffs, U.S. firms are covering the cost, resulting in lower tax payments. Shri Kumar says that the weak jobs growth as a reaction to the price pressures isn't the Fed's fault. It wasn't Powell who imposed the tariffs, he said. Nevertheless, short and intermediate-term bond yields moved sharply lower on Friday in anticipation of a Fed rate cut next month. The 2-year Treasury note yield, the maturity most sensitive to anticipated Fed moves, fell a quarter percentage point to 3.708%. That's a 3-month low, but longer-term yields fell much less, with the benchmark 10-year yield down 0.15 percentage points to 4.225%, just back to where it traded at the end of June. Shri Kumar contends that even if the Fed cuts, bond yields ultimately are heading sharply higher. He sees the 10-year hitting 5% by year-end, while the 30-year long bond rises to 5.75% from 4.8%, a pattern similar to late last year when the Fed lowered rates by a full percentage point. Markets will be vulnerable to stagflation, regardless of who might get sacked in Washington. It's time for the review and preview portion of Barrons magazine for August 4th. New issues are sizzling. Unicorns may be mythical beasts, but multi-billion-dollar startups are alive and well and running wild on Wall Street. Design software firm Figma is the latest company to make a splashy debut. It surged 250% from its IPO price when it began trading on July 31st, and it continued to rise a day later. Figma's explosive start follows strong performances by other recent IPOs, such as stablecoin company Circle Internet Group, cloud computing and artificial intelligence firm CoreWeave, fintech Chime, and drone maker Arrow. Investors are clearly fascinated with companies that are expected to post hefty revenue gains at a time when stock, tech, and other momentum stocks are once again riding high. The Nasdaq isn't far from record levels, buoyed by the strong performance of Magnificent Seven members NVIDIA, Microsoft, and Meta platforms. So, what's next? The IPO market could soon succumb to its typical late summer slowdown. But don't be surprised to see more companies looking to go public in the fall and into 2026. Matt Kennedy, senior IPO market strategist at Renaissance Capital, an IPO research and investing firm, said investors should keep an eye on space tech company Firefly Aerospace, which is expected to go public the week of August 4th, as well as buy now, pay later firm Klarna and ticket marketplace StubHub, which have already filed to go public. And that was reported by Paul R. LaMonica. What happened last week? In markets, the S&P 500 and the Nasdaq started the week extending their record runs. On Wednesday, the Federal Reserve kept interest rates unchanged. 2 voting members dissented, a first in more than 3 decades. The economy expanded in the second quarter, with GDP rising a seasonally and inflation-adjusted 3% annual rate after contracting in the first quarter. Copper prices plunged after President Donald Trump announced 50% tariffs on some imports. On Friday, the markets swooned on Trump's blitz of tariffs and a weak jobs report. He ordered his team to fire the top Bureau of Labor Statistics official. On the week, the Nasdaq lost 2.2%. The S&P declined 2.4%, and the Dow Industrials were down 2.9%. Last week in companies, in a week of big tech earnings, Microsoft posted double-digit revenue growth in its Azure cloud business, and Meta Platforms smashed Wall Street forecasts. A gunman killed 4 people on Monday in a Midtown Manhattan office building, including a Blackstone senior real estate executive. ExxonMobil and Chevron both posted better than expected earnings. In deals last week, Norfolk Southern and Union Pacific plan a merger that will ease coast-to-coast freight travel. Oilfield services company Baker Hughes said it's buying Chart Industries, which sells equipment for liquefied natural gas plants, for $13.6 billion. KKR acquired a majority stake in Healthcare Royalty Partners, which buys rights to pharmaceutical royalty streams. This week, on Monday, August 4th, tech and biotech firms kick off this week's calendar. On semiconductor, BioNTech and Axum Therapeutics will report results before the market opens. After the close, Palantir Technologies and Vertex Pharmaceuticals will release their latest results. On Tuesday, August 5th, key chip stocks headline Tuesday's earnings wave. Advanced Micro Devices is scheduled to report fiscal second quarter results after the market closes. Supermicro Computer will provide fourth quarter and fiscal year 2025 results. On Wednesday, August 6th, iconic American brands, both old and new, will keep earnings season rolling along on Wednesday. McDonald's and Uber Technologies will report second quarter results before the market opens. After the markets close, Walt Disney will release its fiscal third quarter results. On Thursday, August 7th, the Federal Reserve reports consumer credit data for June, and the Department of Labor releases initial jobless claims for the week ending on August 1st. Moving to the numbers, $2 trillion. That's the likely revenue of the top 6 tech companies this year. That's equal to the GDP of Russia, the 11th largest economy in the world. 14%. That's the increase in June quarter sales of iPhones, as some U.S. consumers rushed to buy ahead of tariffs. 30%. That's the portion of single-family home buyers who are investors looking to flip or rent, the highest share on record. And 25%. That's the increase in assets in environmentally focused funds in the year through May, despite ESG's fall from favor. The next headline in Barrons of August 4th, picking the winners in railroad mergers. The deal between Union Pacific and Norfolk Southern could bring fresh life to the sector. Why Union Pacific could climb nearly 50%, by Bill Alpert. When Union Pacific and Norfolk Southern announced their merger deal this past week to form America's first transcontinental railroad, it puzzled some who recalled the Golden Spike driven in 1869 at Utah's Promontory Summit. That final spike connected only 2 railroads from Omaha, Nebraska to Sacramento, California. The proposed Union Pacific Transcontinental Railroad will link every corner of the country. And it may spur a second transcontinental network if Union Pacific's western rival, BNSF, a unit of Warren Buffett's Berkshire Hathaway, feels forced to bid for Norfolk's eastern counterpart, CSX. The resulting freight traffic could get rail stocks unstuck. That'd be another big achievement. A combination of Union Pacific's western reach with Norfolk's East Coast network would cross 43 states and more than 50,000 miles. It would connect the ports of Seattle, Oakland, California, and Long Beach, California, with those in Houston, New Orleans, Norfolk, Virginia, and New York. Union Pacific says a single train could take freight coast to coast without spending 2 days in Chicago shuffling cars between railroads. The time saved could let the railroad win freight business away from truckers, ending years of flat rail volumes and flat rail stock prices. We're going to cut a day or two off every transit time, Union Pacific CEO Jim Vena told listeners on a call to discuss the deal. He would run the combined company. Though the deal will take 2 years to go through the approval process, there's a strong case that it could lift Union Pacific stock nearly 50% in the next 5 years. Union Pacific stock has slipped about 4% to $219 a share since Tuesday's announcement. Norfolk has slid about 4% to $275, which is $45 shy of the $320 announced value of the deal. A share of Norfolk swapped for a share of Union Pacific, plus $88.82 in cash. That discount makes sense for now. The companies say it could take until early 2027 for the merger to win approval from shareholders in the Surface Transportation Board, or STB, which oversees the rail industry. Investors in short-term treasuries could earn a guaranteed 5% in that time frame, while the deal could hit delays along the way. The STB adopted rules in 2001 that raised high hurdles to large-scale rail mergers. Objections may come from shippers and from rivals, such as CSX and BNSF. Unions have already criticized Union Pacific's labor and safety record, but Vena is betting that Washington has gotten more comfortable with mergers. The STB's new chair, Patrick Fuchs, has scheduled meetings that may reassess the 2001 merger rules, and President Donald Trump can appoint a fifth board member to the STB, tilting the body that's now evenly split between Republicans and Democrats. On the Tuesday call, Union Pacific and Norfolk executives contended that their combination would help U.S. port cities by winning away some of the intermodal container shipments now carried by Canadian National Railway and Canadian Pacific Kansas City. Vena said the merger will improve service and expand options for shippers. The two companies currently hand off 1 million cars a year in Midwest rail yards. By eliminating that friction, rail freight will become faster, cheaper, and more competitive with the $400 billion trucking market. One intermodal train removes more than 550 trucks from the highway and is 75% more fuel efficient than trucks, Vena said. The resulting company will also offer significant upside to today's shareholders, said Norfolk CEO Mark George. It'll be a must-own large-cap stock and should trade at a robust multiple. He may be right. Rather than worrying about the spread between the two stocks, long-term investors should be weighing how Union Pacific's Transcontinental Railroad and its rivals will fare. Union Pacific's deal terms value Norfolk at a generous 22 times estimates for Norfolk's 2026 earnings, handing over more Union Pacific stock to leave the combo with less debt. The combined 2024 revenue of the two railroads was $36.4 billion, with $18 billion in combined earnings before interest, taxes, depreciation, and amortization, or EBITDA. In a Wednesday note, J.P. Morgan analyst Brian Ossenbeck forecasts that 2030 EBITDA could be $27 billion, with net profit of $16 billion, or $20 a share. The free cash flow would be $13.6 billion. If an investor put a 13 times multiple on that 2030 EBITDA, comparable to what Union Pacific rates today, the enterprise value of the Transcontinental Railroad would be about $350 billion in 2030, compared with $245 billion for the two companies today. The 2030 market capitalization would be $280 billion, or some 47% above today's combined market caps. Ossenbeck has hold ratings on both Union Pacific and Norfolk, citing their long haul to a closed deal, but he thinks the transcontinental combo could generate substantial free cash. Union Pacific looks like it'll be the most interesting way to play the first Transcon Railroad theme when the dust settles, Ossenbeck concludes. Buffett's Berkshire may be having thoughts about CSX, so that its $100 billion investment in BNSF isn't left at a competitive disadvantage. In combination, those two railroads would rival the reach, revenue, and profit of a Union Pacific and Norfolk combo. Ossenbeck figures that Berkshire could offer at least $43 a share for CSX, which currently trades for $35.50. Berkshire and CSX haven't commented. Our next story, M&A is back. These stocks could be targets. Deal-making is in style again under the Trump administration. Potential takeover targets include C3.ai, Viking Therapeutics, and Lyft by Jacob Sonnenschein. Mergers and acquisitions are back in a big way, and stocks, big and small, should benefit. It's a surprising turnabout. Despite predictions for an M&A revival in 2025, deal-making looked DOA at the start of the year. The dollar value of announced deals globally in January and February was down 14% from the same period in 2024, according to London Stock Exchange Group, as companies waited for Donald Trump to take office, and companies pulled back again in April as panic over the administration's tariff policies took hold. And then Trump started backtracking, and deal-making took off. From April 8th through July 22nd, companies struck over $1 trillion worth of deals, up 34% from the same stretch last year, according to LSEG. For the full year, deals are on pace to reach $3.8 trillion, almost 8% above last year's level. Even that may be underestimating the potential increase. The combination of a resilient economy, less tariff uncertainty, and an easier regulatory regime looks to be putting deal-making front and center once again. Just this past week, Union Pacific and Norfolk Southern announced a $71.5 billion merger that would create the nation's first coast-to-coast railroad. I'm expecting the M&A markets to improve tremendously, says Mike Mufson, managing partner at investment bank Mufson Howe Hunter and Company. It's not if, it's when. Deal-making has been helped by surprising strength in both the economy and corporate earnings. The U.S. economy grew at 3% in the second quarter, while earnings for the period continue to come in much better than expected. Some 86% of companies reporting have topped estimates. When it comes to the business cycle, the M&A trends seem like they're going to be positive for the next 12 months, says Jay Hoffman, co-head of North American M&A at J.P. Morgan. The bigger change might be on the regulatory front. Companies sense that the Trump administration will be more lenient about approvals, and they're trying deals that never would have passed muster under President Joe Biden, like the railroad agreement. That's been a tailwind for deals, says Adam Riley, partner with Deloitte's M&A business. Lower regulatory hurdles could be great news for big tech companies. Many are looking for smaller assets that will help them expand faster than they could on their own. Google's $32 billion acquisition of Wiz will enhance its cloud offerings, while Salesforce's $8 billion all-cash purchase of Informatica will help it manage data in the cloud. Other potential acquirers include Microsoft, Amazon.com, and Oracle, which said on its quarterly earnings call in early June that it wants to pursue strategic acquisitions. And the potential targets? Well, look for companies with market caps below $5 billion, a low percentage of analyst buy ratings, net debt that's less than 3 times expected earnings before EBITDA, and businesses in crowded industries. That's at least according to Wolfe Research strategist Chris Senyek. He screened for stocks matching those criteria and came up with Zoom Communications, Ring Central, DocuSign, and Dropbox, among others. C3.ai stock looks particularly interesting. Shares of the company, which sells a platform to develop new artificial intelligence applications, are down 80% from their 2020 trading debut. A deal that happens at any kind of significant premium to its current price might be a welcome reprieve for suffering shareholders. Healthcare also looks ripe for more mergers. Many large pharmaceutical companies need to bolster their drug pipelines and have the cash to do it. On May 27th, Eli Lilly announced a $1 billion all-cash purchase of Site1 Therapeutics and its non-addictive painkiller that's moving through the trial process. Merck, meanwhile, announced its acquisition of Verona Pharma for $10 billion on July 9th, a move to gain a treatment for various lung diseases. Other companies on the prowl include Gilead Sciences, Biogen, and Pfizer, according to Jefferies analyst Michael Yee. That makes some of the hundreds of publicly traded small healthcare and biotech companies in the U.S. potential targets. Biotechnology companies where analysts project at least $1 billion in annual revenue over the long term, and with strong data on phase 2 trials for new drug candidates, are potential targets, Yee writes. Stocks that fit that bill include Cytokinetics, Scholar Rock Holding, and Viking Therapeutics. Viking is developing treatments for metabolic and endocrine disorders such as obesity and has begun phase 3 trials for a GLP-1 drug. With a $3.8 billion market cap, it could attract an offer from a larger pharma company looking to enter that market. Industrial M&A is also making a comeback. Acquisitions in the sector this year through mid-June totaled $177 billion, more than double the amount during the same period in 2024. JP Morgan analyst Stephen Tusa recommends looking for acquirers that have a history of deal-making but have kept their net debt low, below 3 times EBITDA. That could include Eaton, Roper Technologies, and Danaher, he says. Potential industrial targets that meet Senyek's criteria of having at least 10% expected sales growth, less than $25 billion market caps, and less than 4 times net debt to EBITDA include Construction Partners, which builds and maintains roads and other infrastructure, ride-sharing company Lyft, and Casella Waste Systems, which provides waste management services. Expect a lot of handshakes and some happy investors. Our next story, Hyatt has room to grow. The stock is a buy. The hotel chain's stock has done well for the past few years, but it hasn't kept pace with industry leaders. Well, that's about to change, by Teresa Rivas. Vacations are expensive for you and your hotel. Hyatt Hotels is doing something about it. From crisp sheets to cool pillows and fresh paint, travelers often have high expectations for the places they stay that go beyond the basics of location and cost. The price of real estate and continual upgrades can mount up quickly for hotels and be a drain on profits. It's perhaps little wonder, then, that the industry's biggest players like Marriott International and Hilton Worldwide Holdings have already largely moved to what's called an asset-light model. Now Hyatt, too, is transforming its business to emulate this strategy. It works much like a fast food franchise. Hotel owners get to use the brand name and cachet for their properties, among other perks, while the companies themselves don't have to shoulder the cost of the physical properties and upkeep. This is a long-term strategy that the other hotels have pursued for years, and it's paid off for shareholders in the post-pandemic travel boom, with Marriott's stock up some 200% over the past 5 years and Hilton up 240%. Hyatt has done well too, but hasn't quite kept pace. Yet that could change as it looks to emulate the industry leaders. We like the whole neighborhood, all the big hotels that have built these asset-light businesses with high-quality characteristics, says Mike Smith, head of Allspring's growth equity team. What sets Hyatt apart is that it has a little bit more room for improvement. It's not quite as optimized yet, but it knows the playbook and is on the path, and while it trades at a discount now, that'll go away if it can execute. Hyatt trades at just over 14 times 2026 enterprise value to earnings before EBITDA, a metric many analysts prefer for capital-intensive businesses that include a portfolio of properties. That's below its own 5-year average, approaching 28 times, and Hilton and Marriott at nearly 19 and 16 times respectively. Melius research analyst Connor Cunningham highlighted the stock in his interview with Barrons in early July, arguing that, if anything, Hyatt deserved to trade at a premium, not a discount, given its more high-end customer base. His price target is $166, a 20% premium to the stock's recent $138. That valuation gap may begin to close as Hyatt makes further progress on the asset-light model, as Smith notes. It took a big step forward in that direction at the end of June when it announced that it had agreed to sell the entirety of its owned real estate under the Playa Hotel and Resorts brand. That's a portfolio that includes 15 all-inclusive resort assets in Mexico, the Dominican Republic, and Jamaica for $2.6 billion. The development was so positive that Raymond James analyst R.J. Milligan upgraded his rating on Hyatt to strong buy from market perform on the news, establishing a $165 price target. He highlights that the transaction, 1, was sooner than expected, 2, was for the entire portfolio versus just a portion of the assets, and 3, accelerates the timeline for $2 billion of asset sales that were expected by the end of 2027, and called it a bit of a head-scratcher that the shares weren't reacting more positively to the deal. Mizuho Securities' Ben Chaikin, whose $198 price target is the highest on the street, also praised the deal's terms and swiftness. With more cash on hand, Hyatt will be able to ramp up its expansion to the highly fragmented hotel space. As Cunningham notes, Hyatt is the smallest of the major publicly traded hotels, with just a fifth of the rooms of industry leader Marriott. Just given the sheer size of the company, the growth opportunity is immense, he writes. His research shows that Hyatt competitors have an average 14 hotels per market, relative to Hyatt's 4. That leaves a lot of room for Hyatt to expand to cater to its very active base. 54 million people belong to its loyalty program. Those members also give hotel owners a huge incentive to partner with Hyatt so they can tap that customer base, its digital capabilities, and the company's benefits of scale. Independent operators can seldom offer the amenities, tech-forward renovations, network of properties, and negotiating power with online travel agencies that big players can, making them increasingly likely to sign up with big hotel chains. After dipping this year, consensus estimates call for Hyatt's earnings per share to jump 44% in 2026 to $3.36. Of course, sure things don't exist, and Hyatt is proof of that. If the broader economic picture deteriorates, travel demand slackens, or the financial benefits of its transformation disappoint, investors would probably sour on the stock. Nonetheless, travel demand has held up remarkably well, even after the initial post-pandemic revenge travel boom. And the Playa deal is only the latest of a long list of sales and franchise agreements that show Hyatt is committed and disciplined in moving toward an asset-light model, such as its 2024 acquisition of Standard and bunkhouse owner Standard International. Overall, asset-light holdings will account for more than 90% of its earnings, a figure that stood at just 37% at its 2009 initial public offering. Investors sharing in Hyatt's increased profitability will be able to fund their own beach getaway. And now for the cover story in Barrons magazine, dated August 4th. Trump will remake the Fed. Lower rates are just the start. Reformers intent on overhauling the Federal Reserve are ready to seize the moment. Big changes are in store for the central bank, by Matt Peterson. President Donald Trump wants one thing, quote unquote, that should be very simple, quote unquote, he said during his recent visit to the Federal Reserve in Washington, D.C. He wants interest rates to come down by a lot and quickly. He'll get that, and probably much more, under the next Fed chair. To win Trump's nomination and the Senate's confirmation, the candidates in line to replace current Fed Chair Jerome Powell, whose term ends on May 15th of 2026, are wrapping their proposals for interest rate cuts in far-reaching plans for change. The result is likely to be an overhaul on a scale the Fed hasn't seen in decades. Changes on the table include re-examining the central bank's fundamental mission, changing the way it thinks about inflation and interest rates, cutting staff, and reorganizing or even reducing the number of regional reserve banks. Exactly how these changes will affect markets and the economy is difficult to project at this stage, in part because each of the candidates would put their own spin on any plans. But the structural changes coming to the Fed are likely to amplify the economic uncertainty that's marked the second Trump presidency. Economists and investors who have become accustomed to hearing the Fed chair deliver an analysis of the economy every 6 weeks or so, will be in for something different, perhaps radically so. Fed Governor Adriana Kugler's decision to step down ahead of schedule gives the president an immediate opening on the Fed's board. With the ear of the president, a supportive Senate, and buoyant markets, the new Fed chair could begin rewiring the institution in just a matter of months. Rate cuts are the place to begin. They're not the place to end, said Kevin Warsh, one of the prominent candidates to replace Powell, in a recent TV interview. What needs to happen is nothing less than regime change at the Fed, Warsh said. a Fed in flux. The case for regime change depends on who's making it, but a broad critique of the Fed has emerged during the Powell era, which began in 2018. The Fed has grown from an institution narrowly focused on setting interest rates to one whose execution of monetary policy now supports fiscal policy and influences the U.S. economy in unintended ways, says opponents of its recent actions. The Fed's giant asset purchases, most recently executed during the COVID-19 pandemic, have held down bond yields and enabled more government spending, while simultaneously lining Wall Street's pockets. The central bank believes itself to be unaccountable to the president on monetary policy, even as it's made critical mistakes, such as allowing COVID-era inflation to spike. Fed officials have become economic sages of a sort, publicly rendering opinions about the course of the economy without committing to any particular economic theory. What the Powell Fed sees as institutional nimbleness and intellectual flexibility, its critics see as poorly disciplined thinking and over-reliance on a powerful research staff. The problems have gone so deep that the entire institution needs to be overhauled, they argue. Trump said during his July 24th visit to the Fed that he has two people, maybe three, in mind for the chair. Warsh, a former Fed governor who works with investor Stanley Druckenmiller, is one. Another is National Economic Council Director Kevin Hassett, an experienced macroeconomist who specializes in taxation and is a close ally of Trump's. And the Senate would probably easily confirm either. The dark horse candidates include Treasury Secretary Scott Bessent, who is frequently mentioned but has said he's happy with his current job. Sitting Fed Governor Christopher Waller has said he supports cutting rates immediately and would take the job if the president offered it. But he's not talking to me, Waller told Bloomberg on July 18th. Other possible contenders include former World Bank President David Malpass, recently confirmed Fed Vice Chair of Supervision Michelle Bowman, and prominent conservative economist Arthur Laffer. More may yet emerge. Since taking charge, Powell has presided over a run-up in inflation that the Fed initially described as transitory, and a rapid run-up in rates has brought inflation back down, albeit not to the Fed's 2% annual target. Powell's defenders see the slide down in the Consumer Price Index, from a peak of 9.1% in June of 2022 to 2.7% in June of 2025, all without a recession, as a legacy-defining success. Meanwhile, the Fed's balance sheet remains swollen at $6.7 trillion, but down from a peak of nearly $9 trillion after it conducted an emergency expansion during the COVID crisis. The Fed's staff has grown too, to nearly 25,000 as of 2024, spread among the Washington, D.C.-based Board of Governors and the 12 regional reserve banks. That reflects a rise of about 20% since 2010, according to research by Andrew Levin, a former Fed official now at Dartmouth College. Employment at other large federal agencies has fallen 9% in the same period, Levin found. Powell said in May that he intends to reduce the Fed system's staff by 10% over the next few years through attrition. We are careful stewards of public resources, and sometimes you need to show that, he later said, explaining the cuts. A Doge-type moment. Cuts of just 10% may not be enough to satisfy the Fed's critics. All these PhDs over there, I don't know what they do, Bessent said in a recent CNBC interview. This is like universal basic income for academic economists. Bessent also called for a review of the Fed's non-monetary policy operations, saying the Fed has experienced mission creep and institutional growth that have led to questions about whether it can stick to its core business of managing monetary policy. Former Treasury advisor Larry Kudlow made a similar demand on his Fox Business show. Where's the downsizing? Where's the reforming? Where's the auditing of the Fed? Kudlow asked his guest, Hassett, on July 10th. I think that you're right, Larry, Hassett replied. Government's gotten very big throughout Washington, and one of the places that hasn't really responded yet to the downsizing that we're talking about is the Federal Reserve. The White House didn't respond to requests to make Hassett available for an interview or to emailed questions. The Fed declined to comment. The Fed's Board of Governors would need to approve staff cuts, and it isn't clear how far they might go. Still, caution is merited, and William English, a former senior official at the board who's now a professor of finance at Yale University, I'm not sure that's an experiment I'd want to run. How much can I cut before I really do damage to the institution? English said. The candidates for Fed chair are conducting an informal campaign in financial TV studios and think tank auditoriums, but ultimately they need to win Trump's favor. I do worry about a public campaign with an audience of one, and everybody knowing what it is that audience wants to hear, says former Senator Pat Toomey, a Republican from Pennsylvania who was the ranking member on the Senate Banking Committee, which has jurisdiction over the Fed. Trump's campaign to bully Powell into lowering rates happens to be the wrong outcome for this moment, in my view, says Toomey, but it also neglects the structural changes that I think are necessary. While in Congress from 2011 to 23, Toomey pushed for legislation he argued would make the Fed more accountable. One bill would have cut the ranks of regional reserve banks from 12 to 5, among other changes. The regional banks are quasi-private institutions whose directors choose their leadership, unlike Fed governors who are appointed by the president and confirmed by the Senate. Trump's choice of chair may not only usher in reforms to the Fed's mission and structure, but also disrupt the operations of an institution that's prided itself on consensus. For critics who fear that the next Fed chair will simply dictate Trump's wishes, the crucial question is, can the chair yoke the FOMC to his will? The chair has a lot of power in the sense that they set the agenda for FOMC meetings, said Bill Dudley, a former president of New York Fed and vice chair of the FOMC. A persuasive chair like Greenspan can use that agenda-setting power to bring the committee along when it's skeptical. But in terms of the actual monetary policy decision, the chair can't force the policy decision on the committee, says Dudley. Were the chair to attempt to force analytical conclusions on the staff, at that point you just start having an exodus of talent out of the Federal Reserve, he says. Turmoil at the Fed would rile financial markets. The dollar sold off by nearly 9% in the first half of the year as global investors adjusted for the risk of institutional instability in the U.S., and changes at the Fed could reignite those trends. Imagine that the next Fed chair attempts to take Trump's rate-cutting demands at his word, says Alan Blinder, a former Fed vice chair who teaches economics at Princeton. A new chair may succeed in pushing through a quarter-point cut, but Trump is demanding that the federal funds rate come down 3 full percentage points. I can well imagine a vote on the FOMC where there are 9 or 10 dissents and the chairman loses the vote, Blinder says. The Fed has often thought it important to speak and vote with one voice. Trump's appointment could end that, opening up a challenging new era in which the Fed is less predictable. The just concluded July meeting saw the first 2 dissents by Fed governors since 1993. Bessent, the Treasury Secretary, described it as a schism and sign that with just 2 more votes, Trump-aligned voices could have a majority of the board's 7 governors. They could still be overruled with support of the regional bank presidents. And with that, we've come to the end of our reading of Barrons magazine for the issue date of August 4th, 2025. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.